all starts with a dream and a belief in that dream, especially if you think that it's something that can bring value. There's so much you will learn and so much you will discover, and there's so much that will give you those little bits of surprises. We wake up one day and say, hey, I found a solution to an issue, to a problem.
When we started, Mark and I shared our vision, our dream about Scrum. One by one, those objectives and those dreams are happening.
We didn't have any office like any other startup. We had a farm. We started under the mango tree, even before we went into the home office, even before we went into the garage.
One of the things when we started under the mango tree was someday we're gonna have our own building and workplace. And we have this beautiful building right now that everybody loves to see and everybody loves to work.
I met Gani at PNA. He was my mentor. He was my senior manager. We actually struck it very well. And Gani has always been a very inspirational manager and mentor. We'd always find ourselves talking about dreams, about goals, about ambitions, about stuff that we dreamt about when we were young.
Scrum is a culmination of a lot of the discussions between me and Mark and how we could start something that will have an impact in the Philippines. To give back by doing something in the countryside and providing jobs and opportunities for professionals like us.
It was a combination of many different things, but I think it all boils down to that day when we said, all right, let's try to learn as much as we can. And when we get the chance to go home, let's promise each other to do that and go back and to contribute. So really, what it comes down to is like, this is living a dream.
I realized that the dream is happening, that the dream is achievable when you see happy people working at Scrum. And the joy of having 100 plus people that believe in that dream, closing the gap between, the dream and reality. Nothing more special than seeing that.
Hi, everyone. Good morning. Thank you for taking the time to attend today and join us today. Whether you're a client of Scrub or just want to learn about ESG, welcome. Our webinar will start in a minute. Welcome to Scrub's webinar, ESG Matters, how sustainability factors impact your business. Again, thank you for taking your first step or making another step towards sustainability by joining us at this morning's webinar. I'm Glizel David, the technical accounting lead of Scrub. With me this morning are JM and Angel, who are both from the technical accounting group. You'll meet them both as we go over the session. At any point during this webinar, please send us your questions through our Q&A button, which you can see below your screen. And we will try to answer them later in the webinar. Similarly, if you encounter any technical issues. Again, don't hesitate to send us your questions and concerns, and our administrator will reach out to help you. This webinar will cover latest regulatory trends and requirements. We'll go over key updates and from USSEC, ISSB, and some info on ESRS, emerging stakeholder demands, sustainability risks and opportunities, valuable insights and practical knowledge in navigating the complex sustainability landscape, critical sustainability issues facing businesses today, and the steps that must be taken to stay ahead of the curve. So whether you are a seasoned sustainability professional or just starting to explore the field, this course will provide the key knowledge and tools necessary to drive positive change in your organization and beyond. Before we continue, we'd like to get to know you more through a quick audience poll. The poll should be up on your screen now. In case you don't see it, kindly send us a direct message through the Q&A button. So we have here, what industry are you in? So we have the various industries, and we also have the others option below, and then your business or professional function. All right, so I believe we can wrap up the call now. It seems that there are lots coming from the other industry. I'm not sure what is that. And then yeah, we have the second leading is coming from the accounting, audit, and tax. And yeah, ESG is applicable to all industries. Actually, it will impact all industries. And then your business and professional function, yeah, actually, as expected, most are from the accounting and finance professional. But again, ESG is applicable. ESG is applicable to everyone as well, everyone in the organization. All right. So thank you for your responses. Appreciate all that. So to keep the ball rolling, let's move to our first topic, sustainability regulations and trends. Here's JM to give you more details.
Well, thank you, Glee. Morning, everyone. I am JM Respeto, part of the technical accounting group and actually spearheading the ESG thought leadership at Scrub. Glad to be with you all today. In this portion, we will dive deep into various sustainability regulations and trends. Sustainability has been at the heart of several global leader conferences in the past decades. The demand to protect lives and take action forces evolution into the economic and accounting landscape. This resulted in several regulations being formulated and implemented across the US, Europe, Asia, and actually the rest of the world. In addition, stakeholder trends are evolving as they demand for sustainable businesses. So first, let's talk about some updates on key regulations. Do bear with me as we have a lot of topics to cover in this section. Starting off, first on our list will be the US SEC's regulations and proposal on ESG. In March 2022, the SEC proposed a rule to enhance and standardize climate-related disclosures. This proposal will require publicly listed entities to publish 5 key information surrounding climate-related risk. These requirements are listed on your screen, which will include governance structure, metrics and targets, goals, transition plans, and of course, their GHG or greenhouse gas emissions, which will cover scopes 1 and 2. And for some companies, scope 3, which is a bit difficult, will also be required to be reported on. The SEC initially aimed to finalize this rule last December 2022. However, that got pushed to Q2 of 2023, which we know is already closing. So that's already moved now to probably later near the fall of this year. So we'll keep you posted if the SEC's proposal will be updated by Q3. The delay in implementation resulted from several pushbacks from law firms, regulators, politicians, trade associations, and more. This came from the thousands of comment letters received by the SEC. SEC's initial timeline of implementation will require step adoption depending on how large a company is. It will be split into 3 phases. So here on our chart, we see that the first phase will be for large accelerated filers. Second will be for accelerated filers and non-accelerated filers. And last, companies classified as SRCs. The earliest reporting is expected to happen in 2024, with assurance requirements starting in 2025 to, of course, also provide credibility to these reports. Although the current requirements are limited to public entities, it is expected, similar to other SEC regulations, that will be implemented down to private companies. Nonetheless, a private company's business relations with a public company will undoubtedly affect by this regulation, being part of their supply chain, which is a key disclosure requirement on climate-related information, particularly when we're talking about Scope 3 emissions. As you know, Scope 3 requires disclosure of upstream and downstream activities, which includes suppliers and customers. To put it simply, if you have significant transactions with a listed entity who will then be required to report on this proposal, you will need to provide them climate impact data that they will be using for their reporting. And you, being part of their value chain, should actively participate on this to strengthen your bond with your customers and suppliers. So at this point, if you have clarifications with the US SEC's proposal, feel free to send us your questions through our Q&A, and we will definitely answer them later in this session. Now let's move on to some quick updates on trends outside the US. Let's start with the EU CSRDs, European Sustainability Reporting Standards, or what we call ESRS. On November 22, 2022, the EFRAG submitted the first set of draft of ESRS to the European Commission. The first set of standards comprises the cross-cutting standards, including general requirements, and next is the general disclosures. They also have 10 topical standards, which are spread across the 3 pillars of ESG on environment, social, and governance. It includes climate change disclosures, water and marine resources disclosure, disclosure on impact on biodiversity and ecosystem, and of course, resource use and circular economy. Particularly, you'll have disclosures required for your social pillar on affected communities, your workforce, meaning your people and community. And of course, under governance, how the business conducts their businesses sustainably. Currently, the ESRS is on the hands of EC, or the European Commission, to evaluate the draft standards, which they hope to finalize no later than August 31st of this year. Then the standards will be revisited by the European Parliament and Council, which is expected to be completed no later than December 31st. So we expect that the finalized version of the standards will come out at the end of the year. If you're already familiar with some sustainability reporting frameworks, you can actually see that this ESRS is similarly structured with the Sustainability Reporting Framework produced by the Global Reporting Initiative, or GRI. The GRI standards are also classified into universal, that being the cross-cutting standards of ESRS. They also have the topic standards classification, similar with ESRS, and they do have the sector standards. Now you may be wondering why sector standards are not yet available for ESRS. The release of the sector standards for ESRS are actually pushed later in the next coming years, as they are still finalizing the right fit for each industry. The convergence between ESRS and GRI is actually in line with global regulators' commitment to ensure alignment with these various frameworks. This will help international stakeholders so that they won't have difficulties understanding and transitioning from one framework to another. The GRI, together with other reporting frameworks such as SASB and TCFD climate disclosure frameworks, are widely used reference frameworks in Asia. Now, in terms of timeline, large companies must apply ESRS in the financial year 2024, which will they file their reports by 2025. Listed SMEs are required to report from 2026, with an option to voluntarily opt out until 2028. And for SMEs, they will be able to report according to separate and proportionate standards that EFRAG will develop next year. So what does this mean? Basically, EFRAG will release a set of standards that will cater to the need of smaller entities, similar to how IFRS for SMEs is for full IFRS. Similarly, to provide credibility to these reports, assurance will be required, starting with limited assurance requirement in 2025, and that will eventually increase to a reasonable assurance level in the coming years. So although ESRS is mostly applicable to EU companies, non-EU companies can still be scoped in. So take note of these requirements, because if you have a secondary listing in an EU-regulated market, you will be required to report on ESRS. If you have an annual net turnover in the EU exceeding 150 million euros for each of the last 2 consecutive financial years, then you'll also be required to report. If you have at least one large subsidiary, one subsidiary listed in an EU-regulated market, or one branch in the EU that generates 40 million euros in an annual net turnover, then you'll also be required to report. So basically, businesses outside Europe must get to know this regulation should they want to expand their businesses in Europe. So that's ESRS in a nutshell. The next sustainability reporting standard will provide an update on is ISSB's IFRS on sustainability. On March 31st, 2022, the ISSB issued its first 2 exposure drafts. That 2 exposure drafts include first the general disclosure requirements, and second the climate-related disclosure requirements. So first of these standards is IFRS S1. Its objective is to require an entity to disclose information about its significant sustainability risks and opportunities. So both positives and negative will have to be reported. This will be very useful to primary users of general purpose financial reporting when they assess overall enterprise value and when they decide whether to provide resources to the team in the form of their investments. IFRS S1 has 4 disclosure focus areas, which includes sustainability governance, sustainability strategies, risk management, and metrics and targets. On the other hand, they also released IFRS S2, or the environment-focused disclosures. So IFRS S1 is the general one. So we have here the environment-focused one, which will require the disclosure on information about the company's exposure to significant climate-related risks and opportunities. So particularly exposures on physical risk on climate change, be it acute or chronic, and transition risk. Physical risk on climate change can either be acute, as mentioned earlier, which will include extreme weather events such as cyclones, or those that happen for a short period of time, but are considered regular. Now, chronic risk is a bit more time-bound, where it includes examples such as rising sea levels or rising temperatures. So these are type of events that happen for a prolonged period of time, and which leads to prolonged and towards impact on the businesses. Next risk is the transition risk. This risk is associated with a company's transition from a lower carbon economy. So if they're currently not that compliant with sustainability regulation, they might be required by a regulatory, technological, market, or legal or reputational push to actually move into lower carbon economy. So transition risk would require companies to disclose their budget, their plan of transition, and any cost they will have to incur in order to comply with the regulations. So to reiterate, S1 is focused on the general sustainability disclosures, and S2 is focused on climate-related ones, which is somehow aligned TCFD's climate disclosure requirements. So the implementation timeline for both of these standards is on fiscal year 2024, which is next year already, that will be reporting in 2025. So basically, those are the three big disclosure proposals that are in the works, and of course, it will have significant impact on companies globally. Now let's talk about some other sustainability trends that all businesses must further look into. Although the US SEC is faced with a lot of pushbacks, as we have discussed earlier, and on their climate proposal, interestingly, California is making big moves by pushing bills that will require large companies to disclose GHG emissions publicly. Key to this is their Climate Corporate Data Accountability Act, which has been recently passed with their state senate. This act is more ambitious than that of the US SEC's proposal, as it will actually cover all companies, whether private or public. If we compare to the US SEC proposal, it will just be currently applicable to public, but for this act, it will cover both private and public, which brings in $1 billion in revenue in the state of California. And of course, it will mandate Scope 3 emissions without the materiality and commitment criteria as required in the US SEC's climate proposal. Further, California has been keeping ahead on some trends, including their carbon cap and trade programs. Not sure if you've already heard this before, but the program came into play back in 2013. So the state actually provided large companies within its jurisdiction allowances for carbon emissions, as shown on our illustration. These allowances are provided either as free allowance or allowances subject to auction. The level of free carbon emission allowances depends on the emission reduction target of the state, which is increased annually. Back then, when the program was launched, initially 90% of the allowances are free and only 10% were subjected to auction. But now, in recent years, the level of free allowances already came down to 50%, meaning the state's emission reduction target has increased, and they are already auctioning 50% of the allowances. This auction on carbon allowances allows the state to obtain funds, which are then invested into their GHG reduction fund. Additionally, entities who are able to reduce their carbon emissions significantly are able to auction off their excess allowance and gain funds as a result of the auction. So these entities can actually use the funds generated from the auction to finance their internal green projects, and also they can do it by passing down these benefits to their customers as a form of price reduction. And of course, with that price reduction, they will be able to build their stronger market position. Critical industries scoped by this program includes electrical distribution utilities, natural gas suppliers, refining and hydrogen production, oil and gas sector, and many more. So is everyone still able to follow? Again, if you have clarifications, don't hesitate to send them through our Q&A. The next trend that we'll be covering are carbon taxes. Globally, carbon tax is constantly being considered by governments as a measure to take hold of their businesses' carbon emissions. Some countries, including Argentina, Canada, China, Colombia, the European Union, Japan, Singapore, and many other countries are already implementing carbon tax regulations. While carbon tax can either be levied, meaning passed on to customers by including them on the price of purchased products. For example, an additional 3 cents can be added to per kilowatt hour of purchased electricity as a form of carbon tax. This collected tax from customers will then have to be remitted by the collecting company to the government, similar on how value-added taxes usually works. Another way of implementation of carbon tax is through direct tax. Direct tax by taxing the business a certain dollar amount for every ton of carbon emission. Thus, California is like big in terms of their carbon emission report because that's where they will be getting their carbon taxes or their allowances that they will be giving to companies. Currently in the EU, one trending topic on carbon taxes is the implementation of EU's Carbon Border Adjustment Mechanism, or CBAM. CBAM is effective this coming October 1, 2023. CBAM is an importation tax varying on the carbon emission classification of the goods you are planning to bring into Europe. Currently, there are 3 selected goods as identified by the European authorities, which include cement, iron and steel, aluminum, fertilizer, hydrogen, and electricity. This list of products covered by CBAM is expected to expand as the program matures. The goal of this program is to collect the same carbon tax for goods imported as to the carbon tax that will have to be paid if the goods are actually manufactured within the EU, sort of providing equity to both importers and manufacturers in terms of tax payments. Now, let's move on to the next emerging trend that businesses are still looking into, which are carbon offsets. Carbon offset programs actually allows businesses to either sell or buy carbon credits issued by an accredited organization or state. So this is usually the business of ESG funds or sustainability inclined businesses. They facilitate green investments and actually reduce carbon emissions. So there are 2 perspectives on this. Let's start first with the buyer's perspective. So those businesses who are not able to physically reduce their carbon emissions are given the chance to buy carbon credits as a support to their emission reduction targets. Certain government allows this type of programs as it still will facilitate growing investments into green projects that can effectively reduce or capture carbon emissions. The second perspective is on the view of sellers. So these businesses are exploring new income stream by investing in green initiatives with the goal of having such program registered and ultimately sell carbon credits that will generate revenue. So let's look into one example of a prospective seller of carbon credits. So earlier this year, JP Morgan made the news again when it purchased 250,000 acres of forest land. So this forest, consisting mostly of timbers, is eyed for revenue generation into 2 ways. The first way is actually by selling the timber wood, which is the traditional way of getting your money back from investing in forests. But the new prospective way of JP Morgan is by holding the timber trees as carbon capture assets. So JP Morgan is expected to have this facility registered and eventually sell carbon credits in the near future as their new revenue stream. So they will actually be earning by holding onto these trees and by issuing carbon credits. Last on our sustainability trends are renewable energy credits, which are also being taken advantage of by several businesses. In California, there is actually an REC vehicle market that exists, which is a result of their regulation. This REC vehicle market also exists in other states. So these states actually have zero emission sales targets. So those states will require car manufacturers to sell certain number of clean light duty vehicles. If vehicle manufacturers can't meet their green sales quota, they must buy RECs from companies that do. A well-known provider of RECs is Tesla. Right now, they are the very well-known seller of new vehicles, and they are also the top seller of RECs. If I remember correctly, back then, investors actually viewed REC as a key revenue stream of Tesla. Without that income from REC, Tesla may have incurred a great loss. So that's all of the hot topics on regulation and trends on sustainability. All of these regulations and trends expose businesses to certain risks, and some businesses are also exposed to certain lucrative opportunities. So it is very important to take tabs of these updates to keep your competitive advantage and protect your business of the emerging risks. So by preparing for these trends, you must first assess your business preparedness to risk and possibility of exploring new forms of income. Your income could come from carbon credit programs, selling of carbon allowances, diving into REC markets, and others. Take note of possible recognition of provisions arising from either a need to pay carbon tax or a requirement to purchase carbon allowances or credits. Next, consider the recognition of inventories and intangible assets on carbon credits. So if you're able to take advantage of the market and have a fruitful carbon offset revenue stream, then you have to take note that these carbon credits must be recognized as either inventory or intangible assets. So if you want to know more, don't hesitate to ask questions and get to them later. Next is, if you want to passively participate in the green market, you can always consider investing in green projects that can provide your company passive cash flows. Consider exploring the variety of ESG funds available in the US and other parts of the world. So in the US, SEC actually monitors these ESG funds, and they are also releasing additional climate disclosure requirements for these funds. After considering all of these activities, assess their impact on your cash flows, including impact on future earnings. After understanding regulator requirements and sustainability trends, let's now cover the emerging demands of other key stakeholders. Angel will take us through these matters. So, Angel?
So thank you, JM. Good morning, everyone. I am Angel Ruiz, a technical accounting professional at Scrub, helping Glee and JM in the ESG implementation for clients and professionals. So among company stakeholders, it is true that regulators do have a big influence on sustainability requisites. However, a business should not forget about the demands of other stakeholders, including its investors, employees, suppliers, and customers. So now let's start with the company's investors. Recent trends show that more than half of global investors now look into how businesses manage their ESG risk and opportunities as an important factor in their investment decision making. They screen potential investments based on ESG risk and opportunities, which are good indicators of a business's long-term success. So for example, right now, investors would even vote against executive pay agreements and vote against director appointments if they see that these movements are not aligned with their sustainable goals. ESG funds are getting more attention and funding from investors than other business models, proving that the trend prioritizes sustainability. So next, let's move on to the company's human capital, which is its employees. So global hiring and retention trends show that professionals also focus on a company's sustainable practice when choosing employment affiliations. Factors such as the environment, diversity, equity, and inclusion practices are usually considered in their decision making. So when employees like us feel that they belong or are respected, heard, and valued, they are less likely to leave the organization and become more engaged and motivated to do the job without hesitation, which reduces companies' costly turnovers. So now let's move on to the remaining stakeholders, which are the customers, suppliers, and local communities. So these stakeholders that I mentioned are concerned about a product's social and environmental impact. So they consider how products are being sourced, produced, and even used. So right now, green options are creeping into this stakeholders list as the top factor that they consider, if you're familiar to that. So factors such as renewable sourcing of the product's raw materials, packaging, usage, recycling, disposal, carbon footprint. These items are keys to a customer's brand choices and patronage, making or breaking a company's revenue and success. So considering all these demands, too many demands, right? So businesses, accounting, and professional firms must be prepared and knowledgeable to ensure that they remain strong and able to overcome these waves of sustainable changes. So with that, allow us to do a quick polling question to see if you have encountered already these demands from your stakeholders. Okay, our polling question number 2 is already up in your screen. If ever you're not seeing our poll, please send us a direct message. So for our first question in our polling question number 2, have you encountered a request for any sustainability report or information from any regulator, investor, supplier, state or local government, or customer? Okay, I think some people are already answering. And next question to our poll. Do you consider yourself or your company well equipped to provide an accurate and reliable sustainability report? Okay, I can see people answering. Let's have a few seconds before we summarize and brief the poll. Okay, I think I can see. So some of the participants have already encountered a request for their sustainability report or information from any of the stakeholders. Most haven't received it yet. And most have answered that they are not yet well equipped when it comes to accurate and reliable sustainability report. Okay, I see. Let's stop the poll right now. Oh, so after understanding these requirements and demands, so our next topic right now will cover a quick guide on how businesses should be working to make their businesses ESG foolproof. Okay. So the first thing to do for companies to be able to be ESG foolproof is to, of course, train and educate. So to do that, first, we have to ensure that our board of directors and those charged with governance are well equipped to understand sustainability risk and opportunities to make well-informed decisions. They must be trained to construct and lead sustainability programs aligned with business goals, vision, and mission. And number 2, as sustainability is a company-wide effort, management and employees must be well equipped with knowledge of sustainability, its impact, goals, programs, and what is their desired result. So this will enable them to contribute to the fruition and acceleration of sustainability targets. And lastly, accounting teams must be trained to gather data necessary for sustainability reporting and be familiar with the upcoming disclosure requirements. So tax professionals as well must be trained to be up to date with tax incentives and potential penalties for non-compliance to ensure that incentives are availed and penalties are avoided. So the next one is the sustainability program. So sustainability programs require an appropriate structure to ensure that processes and controls are in place to achieve overall success. So most companies establish their sustainability or their ESG committee, which is tasked to plan, implement, and monitor the progress of the sustainability programs. So part of this sustainability or ESG committee's task is to identify climate, physical, and transition risk and monitor regulations to ensure compliance and report significant matters to the board of directors. So the committee is also tasked to mine the company's impact on all sustainability areas. So these are first, the environment. So companies must understand their impact from sourcing their materials, manufacturing their products, delivering their services, their energy source and usage, how they manage their waste, particularly if they process dangerous substances, and their impact to biodiversity. So on the social impact side, we have to consider factors such as diversity, equity, and inclusion, which are the DEI practices within our organization. We have to also consider health and safety training protocols, impact and coordination with local communities, especially those that are in the indigenous communities and others. So taking all this into account, the company must establish sustainable business practices, policies, controls, and procedures. Now, regarding the reporting requirements, companies must prepare to establish their data gathering process by engaging with current process owners to ensure that the needed ESG data are collected and accumulated in real time. So some reporting frameworks will require reporting downstream and upstream activities. Thus, a company must understand the whole picture of its supply chain. So it must understand how it will connect to its suppliers to get accurate data on the matters such as the carbon emissions, including other environmental and social impact criteria, which are relevant to the company's reporting, particularly for the Scope 3 emission disclosures. Now, having the proper understanding of its value chain, the company will be able to implement environmental and social screening criteria and processes to ensure that the supplier chooses are those that also have sustainability in their mind. So similarly, with the company taking on the supplier hat to other businesses, it will be better prepared to provide ESG data to its customers to support the reporting requirements. So this preparedness, I know these are a lot, but this preparedness will provide the company with a competitive advantage in the market. So sustainability frameworks also require companies to publish their commitments, their risk management process, and their programs, including their targets and metrics used to report on their progress. So with a long list of things to do, I know there's a lot. Some companies really have difficulty adopting and implementing what's needed to meet the sustainability demands. So coming from our earlier poll, I understand that not everyone is already trained and equipped to meet the requirements, although some haven't received it yet. And this is true for all industries. You're not alone. So however, the greatest solution for this one is involving and pulling in sustainability experts to help you with the requirements so you can remain focused on growing your business. Now let's move on to our third polling question. Here's Glee to take us to that. Hello, Glee.
Yeah, thank you, Angel. So now on to our last polling question. So I believe you can already see the poll in your screen. So have you consulted ESG professionals to assist you with sustainability risk and opportunities assessment? All right. Yeah, I can see the responses, most of the responses now. Let's wait for a few more participants to answer. All right, so maybe we can end the call now. All right, so it seems that most of the attendees haven't consulted yet ESG professionals, probably because of various reasons, right? So actually here at Scrub, our professionals are trained to support businesses in navigating the sustainability landscape. If you can see on your next screen, you can also stop sharing the poll. So yeah, on your next screen, our ESG team can work with you on your needs. We can provide training to your board, management, and employees about the ins and outs of ESG reporting globally and within your region. We provide education coverage on key matters such as intro to ESG and sustainability reporting, existing and upcoming regulations, corporate governance, the role of the board of directors, management, and operating departments, establishing and communicating policies, ESG preparedness, dealing with GHG emissions, understanding your value chain and their impact, employee and customer considerations, accounting and reporting ESG related assets and transactions, diversity, equity, and inclusion, and other topics. We also assist companies in establishing their sustainability governance structure and risk management by revisiting existing processes, procedures, and controls to identify the risks to be addressed and opportunities to seize, align with emerging market trends, particularly on environment, health, and safety. We provide policy advisory and creation in compliance with sustainability regulations by identifying policies to establish and assisting in preparation and execution of those policies and controls. And of course, to take over or provide support on accounting and reporting of ESG related transactions, and on the preparation or compliance review of sustainability report preparation. So if you need any support on your sustainability journey, feel free to send us an email or connect with us at knowledge@scrub.net. As promised, we will now answer some of the questions we received during the session. All right. So yeah, before proceeding with the question, I want to highlight as well, JM, you mentioned earlier when you're discussing the timeline that while a company is not listed, or even if the company is an SRC filer, if their suppliers or customers are listed, they will have to they need to have that sustainability and other ESG reports on that large accelerated filer timeline, because of those reports will be required by their suppliers or customers, right?
Yes, correctly. So definitely, if you're heavily involved, if your main customer is a large publicly company, which is the usual case for most of the private companies, then you definitely have to cooperate with them because there's a risk of possible disengagement or them looking for other suppliers that are more amenable into providing reports about sustainability on carbon emissions. And carbon emissions are a bit tricky to report on or to
Mhm.
calculate actually and translate your data that you currently have to actual carbon emission reports.
Yeah, so that's why really it's critical to be prepared ahead of time. Yeah, and
Yes,
I was
yes.
able to capture. In addition, investors and consumers are heavy now on ESG. I mean, some are requesting reports or checking their sustainability reports. So it's an advantage to be prepared internally, meaning incorporating ESG in the daily operations. So they'll be ahead of the curve. And also there are other benefits, as you mentioned, like other tax credits that an ESG ready company can enjoy. Yeah, maybe we can proceed with the. We received some questions here. Um, what are the ways to sell carbon credits, and who can I sell them?
Okay, let's dive into that. So carbon credits usually operate in a state or country with prevailing regulations. So these countries usually are part of the are the signatories of the Paris Agreement back in early 2015, I think. So if your country is part of that signatory, definitely your country will have carbon emission reduction targets. So your first step in order to like establish a carbon credit revenue stream is to first look into the carbon credit structure of your country, look into the rules of carbon crediting agencies, build your business from these requirements, have your business or your carbon capturing facility registered by these carbon crediting agencies. And from there, you can already start trading these carbon credits. Your buyers will be the companies who are unable to meet government mandated carbon emission reductions. So in some countries, there are like implementation of both carbon credit programs and carbon tax programs. So so basically, if you have a carbon tax ruling, companies who exceeds the carbon allowance will have to pay the tax on that excess carbon emission. Now, alternatively, to avoid that tax, what they could do is buy carbon credits from existing carbon crediting facilities to ensure that their net carbon emission, so we're not reporting on gross, we're reporting on net. So it's all of your emission less your carbon credits. So by purchasing carbon credits, your net emission could be below the line of the allowed allowances. So by purchasing that credit, you can avoid the carbon tax. While carbon credits are usually priced similarly to how the carbon tax is implemented, say for example, your carbon tax is $100 per 1 ton of for every kilogram of carbon emission, then usually around that range, the carbon credit will also be priced. So why is that? Basically, it's a trade-off between a company by paying for the carbon tax or buying the carbon credits. But in some ways, carbon credits could be priced higher than the carbon tax. So why could they do that? Because of course, companies would prefer not to violate any regulations in terms of paying tax. Because it's like a negative perception, it will result to a negative perception to their investors. So instead of paying the tax, just invest to these carbon credits. So that's how you could establish actually, or that's the basis when you try to establish your carbon credit program.
All right. Yeah. Thank you for that, JM. And we also have a next question here. What are some of the common challenges you've seen companies experience when it comes to implementing sustainability practices?
Yeah, so the biggest challenge faced by companies is knowing when and how to start their sustainability journey. Basically, they are concerned with costs and it's not their priority, thinking that it wouldn't impact them that much, given their insufficient understanding of the risk and benefits of ESG to their company, their people, the community they operate in. Companies are also somehow hesitant to adopt to the change. Another key area of challenge is data gathering. It is very, very, very tedious and will require a lot of efforts to actually gather the data and process it to a reportable form. So with limited capabilities on the ins and outs of ESG, companies finds the data they need to properly report as very burdensome and a bit fearsome given the vast requirements for in order for them to report in compliance with the frameworks. So overcoming these challenges is actually where we help our clients.
All right. Yeah. Actually, some are deferring because they're saying that it's not yet applicable, or I mean the standard or the regulation for some. But yeah, preparedness is the key.
Correct.
All right. So next question. Oh yeah. So in relation to that, why should we act now, or when is the best time for us to start, or where should we start?
Again, Glee, for all sustainability agenda, now is always the best time to start.
Mhm.
Adapting to the requirements of ESG is not a one night fix all type of project. Industry leaders actually took time and phased all their programs to long period of time, say a 3-year program, a 5-year program, to actually give their entire community, not just the management, but their people, their external communities, external stakeholders, the sufficient time to actually adopt and ensure that proper transition is done without overlooking any aspect. So expect that if you're not a publicly listed companies, if they're your customers, they will reach out to you to get data on how you process or manufacture the product or service that you're providing them. So cramming is not an option when it comes to addressing sustainability risks.
Yeah, it's difficult to cram, especially you need to collate lots of documents. You need to onboard people with that new policies and procedures that's required by the regulatory agencies and standards.
Yeah, it's not just like publishing a report. There's a
Mhm.
lot of like restructuring things that you have to do within the organization.
Yeah. Yeah, that's why I think that's why the training that we offer to the companies and their staffs are also relevant for awareness and for
Correct. Yeah.
preparedness. All right. Do you have data, an example, how many adopted already or how many investors request for report, something like that?
Actually, as of date, more than 90% of the S&P 500 companies have published their sustainability reports. Because although the regulations to actually publish the report is not yet finalized, as we've
Mhm.
discussed earlier, they do have a commitment to the Paris Agreement to actually reduce their carbon emissions. And that's basically taking accountability of their commitments. So 51% of these S&P companies are reporting under GRI. So although they are in the US, they can actually elect to use GRI since the standard for US is not yet there, which means that the lack of formal and final implementing rules and regulations did not stop them from taking accountability of their business impact. And on the other hand, on the investor side, 70 to 80% of top global investors are looking into sustainability reports. And they actually demand for more accurate and reliable reports that are not what they call greenwash. The certain companies do tend to say very flowery language that they're doing this, but they are in fact not doing it. So there are ways to actually report if you haven't done it, and there are ways to probably be more reliable in terms of your reporting. So we do help clients in terms of balancing the proper language for the report. So market data shows also that around 80% of employees, investors, customers want to actually buy from, invest in, and work for companies that share their profession, their personal values. So there are a lot of already big percentages from market who are very interested in terms of ESG reporting.
Yeah, there's a new word I heard, like greenwash. So
Greenwash,
meaning
yeah.
they're reporting but they're not doing.
Yes, so greenwash is basically the ESG equivalent of whitewashing. So you're saying that you're doing this, but that program is actually half baked. You
Mm-hmm.
haven't fully implemented it. It's just there. Say, for example, we have this policy on health and safety, but in fact, when we looked into your data, there are a lot of like health and safety concerns from your employees. So it means you have the policy, but it's not operating effectively. So that's a sample type of greenwashing.
Yeah, and also when I visit some of the websites, some of the companies also publish their ESG activities on their website, right?
Yeah, and most of greenwashing actually also results to reporting a greenhouse reduction that is overstated. So without proper identification of like your base reporting for carbon emission, you won't be able to provide accurate reporting on how many how many tons of carbon have you actually removed from your operation or reduced from considering your base year.
Mm-hmm. All right. And probably we'll just wrap up and just ask the last question here. So, how can Scrub help me with ESG? Do I need a special ESG consultant?
So thank you for this question. Currently at Scrub, we have a team of ESG skilled professionals who can actually help you from doing ESG health check. Because I've mentioned, although the requirement is not yet there, you can start by doing ESG health check to see where you at currently and where are the loopholes and where are the opportunities for you to explore on. We could also provide, our skilled professionals could also help you in terms of ESG reporting adoption, updating your policies to align with ESG goals and requirements, and actually to avoid greenwashing, cascading, implementing, and ensuring that those controls or policies are operating effectively. You can also train your people to ensure that ESG adoption will be a holistic approach and not just like a management reporting thing. We can also actually take part. So on Angel's discussion earlier, she said that one step is to establish an internal ESG committee to help in executing the sustainability goals. We can actually take part or we could like be a representative on your ESG committee to help you execute sustainability responsibilities.
Yeah, because like ESG is a big thing. We can implement, adopt it in phases, right? So,
Yes, correct.
yeah. All right. So I think that's it. Hope we were able to provide clarity on your questions. Given our limited time, we'll connect with you for your other questions. Please expect an email from us to discuss your concerns. So at this point, we'd like to thank everyone for attending this webinar. And we hope that we were able to provide you insights on the emerging hot topics and sustainability. Again, if you have concerns or wish to connect with us further for any assistance, don't hesitate to connect with us at knowledge@scrub.net. This has been Lizelle with JM and Angel, and together with the Scrub team, we thank you for your time. Have a nice day.